Tariffs are back and the stock market is tanking, falling to a critical level. But the real story is what's happening to the dollar and global bond markets. After a new tariff bombshell against Europe this morning, stock markets are plunging over 1% lower. And the US dollar is paradoxically declining after President Trump announced a new 50% tariff to go into place in just a few days. Today, we'll look at how markets are responding, why the bigger story is actually the least discussed, and give an update on big news out of Japan. So overnight, just an hour or two ago, President Trump announced that due to discussions with Europe going poorly by his characterization, he would be threatening this 50% tariff against European goods. Clearly, the stock market did not like that. Futures fell immediately, and currently the SPY, which is an ETF that tracks the S&P 500, is down 1.1%. The Nasdaq is down 1.4%. The Dow Jones Industrial Average is down 0.9%, along with the IWM, the Russell 2000. We don't think that this is actually the biggest story, although it is important to point out that the S&P is getting back down to some critical levels here for traders. Uh, Generally speaking, this 200-day moving average is starting to get pretty close. This is a huge level that both retail and institutional traders both watch. Currently, that 200-day moving average, you can see in dark maroon color, that is currently about 5,700, and we are trading 5777. We are getting close to the 100-day moving average, which we can see in the slightly lighter color, and that is right above 5,700. So whether or not these act as support, that will be kind of a critical level to watch. It does most likely fill this gap, which I've been talking about, and I've been urging caution for the past week or so regarding this rally. It just looked completely overextended and due for a pullback, and we've gotten a 3.5% pullback so far. It is currently in this gap, and if I had to guess, I would say that it most likely comes down, fills the gap, which also corresponds to the 100-day moving average and the 200-day moving average. Whether or not it bounces there will probably depend on other factors like rates, further news, that kind of thing. What I think is really interesting is on this news, the dollar actually declined. We can see Bitcoin declined initially, is currently bouncing pretty well. VIX volatility index is spiking. But rates, even though the long bond initially got bid, both the 10-year and the 30-year, you can see this long wick to the downside. This means that long bonds got bid. The long bond is reversing that, and rates are almost unchanged on the day. The 30-year looks unchanged on the day. This is generally not what you see. In my opinion, this indicates pretty strong trend for higher rates. The fact that we've talked about for a long time that we don't think tariffs are as inflationary as they are a negative growth shock. And when you have lower growth, when you have a tariff is just a tax. It disincentivizes kind of aggregate economic activity. And this is generally what we've seen reflected, whether it's inflation break evens, bond markets, not just in the US, but kind of globally. Oil is still down over 11-12% since Liberation Day. But the fact that long bonds couldn't get bid, the fact that long-term rates only very briefly came down below 5% on the 30-year until basically immediately reversing that, we think is incredibly notable and shows that, sellers of the long bond are willing to step in. Remember, the value of the bond is inverse to the yield. So this is what the value of the bond would look like on a daily chart here. Sellers stepped in very quickly. The value of the long bond started to pop on the news, and that got sold pretty quickly. So This is why we see rates moving higher, and we think that that's pretty notable. I mean, a 50% tariff, Europe is a critical trading partner of the US. We do a lot of trade with them. Uh, and, I think that a 50% tariff on Europe is a lot different than a 50% tariff on the Penguin Island that everyone was talking about just a month or so ago. The other critical piece that we just kind of mentioned was the dollar and the fact that the dollar weakened. And so the reason this is unusual or worth talking about is that generally speaking, currently the dollar's trading by the DXY index down 0.5%. Um, Generally speaking, when a country implements tariffs, that country, the country implementing the tariff, their currency will strengthen. And the reason for this is there's a few reasons for this. So the first reason is an improved or an expectation of an improved trade balance. So, kind of by definition, we mentioned tariffs are a tax. They're a tax on imports. But they put another way, or on the other side of the coin, are an incentive for domestic manufacturing, for domestic output, for exports. By definition, tariffs raise the cost of imports while maintaining exports at the same cost for domestic consumers. And so, if imported goods are being made more expensive by the tariff, which is the goal, this reduces imports. But if exports remain steady or even increase, which is kind of the whole goal of this administration, the trade balance would improve. Because remember, the trade balance is exports, the difference between exports and imports. And what this does is it increases the demand for that country's currency. Foreign buyers need more of that currency in an expectation of kind of increase in exports. And clearly, high demand for a currency would strengthen it. The other reason is capital flow expectations. So tariffs, generally speaking, especially in the context of the past few decades, indicate protectionist trade policy that favor domestic manufacturing, domestic industry. And especially in the context of the U.S., which has so badly hollowed out our industrial base for so many decades, this should attract global capital as reindustrialization and clear intent to reindustrialize. This can attract foreign capital, and as foreign capital comes in, right, in an expectation of funding factories to be built and fund that reindustrialization, foreign investors are buying the currency. Again, that increase in demand, will strengthen the currency. So generally speaking, the country implementing the tariff, their currency will strengthen. But what did we see today? We mentioned the DXY is down 0.5%. We think this is notable because generally speaking, the dollar should be strengthening. And also, this move down in the dollar is part of kind of a larger trend that we think is notable. So here, we mentioned news out of Japan that we'll get to at the end. But here we have an interest rate differential between the US 10-year and the Japanese 10-year. And then we have the dollar yen exchange rate. So we've talked about this in many of our videos, but generally speaking, one of the main ways a currency is valued is on interest rate differentials. So here in red, we see this interest rate differential between the U.S. and the Japanese 10-year. So the same duration for the bond. The only difference is the country that is issuing it and the interest rate that that country is offering. So hopefully this makes intuitive sense. But for example, if the U.S. 10-year was offering 20% yield, we'll just use some extreme examples. If the U.S. was offering 20% interest on their 10-year bond, but the Japanese 10-year bond was only offering 0%, well, clearly foreign capital would generally flow into the US to get that 20% interest rate. This is the general concept behind an interest rate differential. And what we can see here, as this red line goes up, the spread, right, the rate that the US is offering relative to the rate that Japan is offering, as this red line goes up, the US is more competitive. The US is offering a higher rate. And what we can see is this, clear trend, this clear correlation where as this spread comes down, where the US is offering lower rates relative to Japan, the dollar would weaken, right? And this makes sense because remember, when global capital flows in to buy bonds in, say, the US, bonds are dollar denominated. So they need to buy dollars first. And we've pointed this out, but bonds are basically dollars, and dollars are basically bonds. Dollar is just a zero coupon with no maturity bond. A bond is just a dollar that offers an interest rate and has a duration to it, a term to it. And so as this rate comes down, the dollar weakens. As this rate goes up, the dollar should theoretically strengthen. And and that's what we've seen post Liberation Day. The 10-year Treasury versus the Japanese JGB, 10-year JGB, this spread has increased by, what is that? 2.7 to 2.9, call it 30 basis points. And yet, what have we seen since Liberation Day? The dollar has actually declined, right? And so this divergence is what we've been pointing out for many weeks now. And we still think that it's incredibly notable that you see the dollar not only not strengthening, but you see interest rate differentials actually should be increasing dollar, right? Strengthening the dollar, but we see the exact opposite, which is the dollar is weakening. Now, remember, that might sound bad, especially if you're an American. No one wants a weak currency. That sounds bad. Well, remember, the dollar is grossly overvalued due to the structure of the system, Triffin's dilemma, resource curse, and Dutch disease, right? All these concepts that we've spoken about. The dollar is grossly overvalued. If Trump and this administration really wants to reindustrialize, they need a dollar that is fairly valued. Theoretically, in trade, global trade, the currency should be able to act as kind of an equalizing force that creates an equilibrium. Well, that mechanism is broken due to the global reserve currency status of the dollar and kind of this overvaluation of the dollar. So I have always said that tariffs alone would not accomplish the goals of this incoming administration, and they need a weaker dollar. Well, how do you get a weaker dollar? One of the ways you get a weaker dollar is for the dollar to trade on balance of payments, which is kind of what we basically saw in that first week of April when everything was just, rates were skyrocketing, the dollar was tanking, the stock market was tanking. That was basically a very short-lived balance of payments crisis. This is a phenomenon you see in emerging markets. If you want kind of more in depth, if you didn't catch that, it was published in the first week of March. I did a couple videos on it. But that's basically what we saw with that dollar weakness. On a balance of payments basis, remember, the US runs a massive twin deficit. And so, again, the dollar on a fundamental basis, because of that twin deficit, because of the US's balance of payments, should be much weaker. And so, by basically kind of encouraging a fair valuation of the dollar, you get a weaker dollar. And sure enough, that's what we've seen. So we've seen the dollar weaken post Liberation Day, and over the past couple weeks with people freaking out about what's going on with Japanese yields. It's important to point out that look, yes, Japanese yields are much higher, but so are U.S. yields. And the difference between the Japanese yield and the U.S. yield, for example, are basically flat. They're basically unchanged. But post Liberation Day, there's this kind of clear trend where U.S. rates are higher, but the dollar is weaker, and this goes back to kind of an encouragement through policy for the dollar to trade on fundamentals like balance of payments. So here's that same exact concept, but applied to the euro. And I think this one is even more clear. It's more obvious even than the Japanese. And here I'll put a line on April 1st. So we can see this. This is the euro USD. So remember, as the red line goes up, the euro is strengthening versus the dollar. And then here in white, we have the European average 10-year yield minus the US 10-year yield. So it's the same exact concept. It's the interest rate differential. And what do we see? since Liberation Day, Europe has actually offered lower rates, but the euro has strengthened. So again, this is the same divergence. I know currencies and interest rate differentials might sound confusing. There's kind of a lot of moving pieces, but it's an exact same dynamic that we saw here with Japan. It's exact same dynamic. Excuse me, euro rates are decreasing relative to US rates, but the euro is strengthening. So, again, this goes back to, on a balance of payments basis, the dollar is grossly overvalued. And by policy mechanisms like we've seen, the Trump administration can get a weaker dollar, which I have, long argued is really the goal and really the thing to watch. People kind of, the tariff headlines can be very day to day, week to week, volatile, right? And people are kind of, I think, chasing tariff headlines too much. Anytime Trump implements a tariff, it's see he's trying to, I don't know, crash the global economy or whatever people are saying. Anytime he reverses, it's see he's capitulating and he really doesn't want any of the things that he says he wants. I think that people need to zoom out, try not to get kind of too engrossed in the day-to-day changes in tariffs and look more at these longer term trends, these bigger, more macro trends. And I will also point out that this trend in interest rate differentials with the euro goes back a long time. So we pointed this out, a while ago, but this euro average has actually been declining going back to the prior administration. There is this clear kind of general downtrend, but yet the euro has been in this kind of uptrend, right, in terms of euro strength. So this is not just a post-liberation day trend. It is part now. The trend before, kind of this bigger trend I'm talking about, it was certainly much more gradual, and you have to definitely point that out. It is not nearly as pronounced as the divergence we're seeing post Liberation Day, but it is kind of I think, an important context, which is this trend was kind of already in place for over a year, very gradual, but you can see that this kind of euro strength trend has been in much more of kind of a general uptrend, whereas the euro average, the interest rate differential, has actually been getting worse, generally speaking. Very gradual around the margin, but certainly kind of important, larger context to take into account the much more kind of violent or pronounced euro strength post Liberation Day versus a steep decline in the European average 10-year yield versus the US. So, what is the big news out of Japan? Well, their inflation rate data came in overnight, and we can see that it came in at 3.6% year over year. Now, in the US, currently CPI inflation rate is about 2.3%, if memory serves. And, generally speaking in the US, we covered this in the last video we did, but, we clearly had a spike during 2021, 2022, about 9% at the high. And the US inflation rate has been plummeting, right? It did a very similar thing where it came down, initially, kind of set like, traded in a little bit of a range, kind of up near 3%, 3.5%. But then the US rate took, US inflation rate started to decline pretty notably in the past quarter or so, the past few months. Well, we see the exact opposite in Japan, which is it came down, right? It had that initial decline. But then, starting in October, late last year, it started to increase and has not really shown disinflationary trends. So here I want to overlay the 10-year JGB. And if you want a more in-depth coverage, analysis, or my opinion on what's going on in Japan, I have a whole video for that. So I won't go super in depth here, but this move in the 10-year yield for the JGB, for the Japanese 10-year, and the 30-year and the 40-year, there are fundamental drivers behind it, which is solid growth, right? Wage growth, inflation, which is a component. Remember, inflation is a component of nominal growth. There were strong fundamental drivers kind of already in place for Japan. And now that is not to say that the entire move in rates can be attributed to just these fundamental drivers. Of course, there's kind of a risk premium being baked in and other factors. But generally speaking, it started with strong growth out of Japan. And in fact, Japanese kind of outperformance. Now, remember, Japanese net international investment position is about 90% of their GDP, about a positive 90% of GDP. It is trillions. I believe in US dollar terms, this is about $4 trillion. Uh, and remember what the net international investment position, or the NIP for short, is it's the difference between what that country owns of foreign assets versus what foreigners own of that country's assets. It is the net. So it is the difference between those two. It is not a gross number. The gross number is significantly higher. If you look at just the gross number for what Japan and Japanese citizens and businesses own of foreign assets, it's over 6 trillion. So the net international investment position by comparison for the U.S. is negative 100% of GDP, between 90 and 100% of GDP. So basically what's been going on here, and we think why a big reason that we see the yen actually strengthen. Remember, as this is the dollar is the numerator here, so as this white line goes down, that means the yen is strengthening, the dollar is weakening. um, if Japan was really imploding, if this was really the end of the world, why is their currency strengthening over the past week or two? It makes no sense. And in fact, the US 10-year rate is actually kind of higher post Liberation Day than the Japanese 10-year rate. So, if anything, the yen should be weakening on an interest rate differential basis, but it's not. It's actually strengthening. What does this indicate? This indicates that, right, Japan is the largest foreign holder of US Treasury debt, not just on a central bank level, on a sovereign level, but also Japanese citizens and businesses own a huge amount of US dollar assets. As yields rise in Japan, the point of yields rising, the reason that the bond value is inverse to the yield is that the yield is basically there, you can think of as a way to entice people to come in to buy the bond, right? So as the value of the bond actually declines, you get a higher and higher rate, a higher yield to try to entice buyers to come in to buy the bond. And then the yield will decrease, right? The value of the bond will go up. And so as Japanese rates move higher, there is an eventual level where Japanese businesses and citizens go, yeah, 4%. Okay, that sounds great. And I will sell my dollar assets and I will bring that money back home. Remember, when they're selling the dollar, they're buying the yen. So that is, we think one of the reasons we've seen actually yen strength, despite the interest rate differential not really moving over that same period of time, basically range bound, and kind of post Liberation Day, actually, the U.S. rates are actually higher. We think that that's kind of what's going on. Is that this indicates that the repatriation trend, which I will point out, I have been talking about since January, long before it was a front page headline on CNBC. This repatriation trade and trend has been visible, if you pay really close attention, for going back to January, February. And I think that is really the only explanation for why the yen is strengthening versus, over this period of time, over the past couple of weeks, as rates have really skyrocketed in Japan. The interest rate differential versus the US hasn't really changed. Post Liberation Day, US rates are actually higher, and yet the yen is stronger. We think that that's basically an indication of Japanese repatriation. Now, remember, these repatriation ideas do not happen overnight. This is not an overnight light switch sort of thing. Macroeconomic forces and capital flows take months and months, if not years, um, to fully play out. So this is just something, in my opinion, there is no indication of some sort of cataclysmic end of the world event. It is something to keep an eye on for sure. But we think that there are these fundamental drivers like inflation um, which have been driving rates higher. And remember, wage growth is also strong in Japan, and it is relatively strong. So if you look here in purple, is the Japanese inflation rate versus the US CPI rate. And what we can see here, that's what this purple line is here. This is the Japanese inflation rate minus the US inflation rate. And we can see that, late last year, their inflation rate started to increase relative to the US inflation rate. And sure enough, what happened with bonds? Well, bonds started to really take a leg lower, yields higher, late last year. And this is, again, there is a fundamental driver. There's a reason. And you can say inflation is bad, but it is, just objectively sign of higher nominal growth. And so an expectation for higher rates actually makes sense. This is just how bond markets work. This is just how it goes. Now, of course, there are risk premiums, term premium, and maybe financial repression risk, right, due to Japan's debt to GDP, right? All the dynamics we talked about in the more in depth video, all of that is certainly at play. But it is important to remember that Japanese inflation is actually, taking a leg higher relative to US inflation. US inflation, like we mentioned, is actually taking kind of a leg lower over the past quarter, over the past couple months. Well, we can see here in white that Japanese inflation has taken a leg significantly higher, right? At its low here in the end of October of last year, inflation was 2.3% in Japan. Now it is 3.6%. That is, in just 6 months, that is a pretty significant move. And so there are fundamental reasons for the move in rates in Japan. And it'll be something to keep an eye on. Clearly, there is a breaking point where pension funds, insurance funds, banks that are loaded up on JGBs at 0%, the value of the bonds is collapsing as yields move higher. And so clearly there is signs of a potential stress, but like we pointed out here, we are actually seeing yen strengthen, and especially post Liberation Day, as U.S. rates are actually higher, the yen is strengthening. And the yen strength is part of a larger trend that goes back to late 2024 when I first pointed out, hey, the yen looks like a good long here. It was because of the fundamental drivers here. It was because wage growth was actually reaccelerating, inflation was actually reaccelerating, while US growth, nominal growth, was kind of, moderating. And so I think that, too much panic and too much kind of fear mongering over the Japanese situation is missing some of these kind of more important nuance, like interest rate differential, strength in the currency, as well as the fundamental drivers. So markets getting a bit of a bounce here. The S&P is now down 0.9%. So yeah, definitely no shortage of interesting times, especially if you're a macro guy. Looks like volatility has come in a bit, but look at this. Yields are now higher on the day for the 30-year yield. The 10-year is almost unchanged on the day, and the dollar is weaker. So we have yet another day of stocks down, bonds down, and dollar down. This is textbook capital repatriation, textbook rotation. And remember, this is not a bad thing. This is actually how you get a weaker, more fairly valued dollar, right? Which brings kind of industrialization, high paying manufacturing jobs back to America, right? Boosts wages for the bottom 90%, as manufacturing is just generally, objectively speaking, higher paying job than something like a low paying, low skill service job like leisure and hospitality and healthcare. So these are not necessarily bad things. Capital fleeing the U.S. That might sound bad, but remember that is how you get a weaker dollar. Because on a balance of payments basis, the dollar is grossly overvalued. This is one of the ways that you get to a weaker dollar, and sure enough, that's what we've seen. Sure enough, the dollar is down over 3% since Liberation Day. Right, stocks are higher than they were pre-Liberation Day, but the dollar is down, oil is down. and rates are marginally higher. And so all I think this what is important is to take the entire kind of broader context into account and try not to kind of get so wrapped up in the day-to-day headlines because it is chaos basically. All over the place. Every day is a new headline. Every week is another huge move in stock markets because of these kind of rapid, volatile changes in tariffs. So I think kind of zooming out. Hopefully that was helpful to give a bit of a zoom out. Again, this kind of larger trend of dollar weakness, especially with the euro. Again, this goes back to 2024. And so, it is not just an overnight thing that has been developing here. Um, so hopefully that was helpful. Hopefully it gave some context on where markets are trading. Help to explain some of the move in bond markets and currencies. And remember, just because it sounds bad doesn't mean it is bad. Now there is a downside to a weaker dollar, of course. I will always mention this, which is a higher cost of imports. So this can have an inflationary impact, especially if you match it with a 7%, 8% budget fiscal deficit, like the tax bill is doing. But currently, markets are not pricing in a high degree of inflation. You look at inflation break evens; they are basically flat with the same exact level that they were before Liberation Day. Bond yields are higher, but we've covered this is mainly due to an expansion of the kind of real yield, the real rate. And so yeah, hopefully that was helpful. If anyone has any comments, questions, maybe do a follow up tomorrow on any of the concepts I touched on. Just leave a comment, and yeah, hopefully.